Good morning, it's Tess, and this is Stay Curious with Tess. And today I wanted to talk about a word, and the word is liquidity. And the reason I wanted to bring this up is liquidity can come to us in different ways, and it puts us in a position where we may need money, but it made me think about like how I probably would have, not probably, I absolutely would have done things a little bit differently had I been in a different place at the time that I left the W-2 world into where I'm at right now. So today I wanted to talk about liquidity, and I wanted to talk about it from a perspective of defining it, understanding it, so that when we decide, when we make decisions, we make better decisions. So today, my word is liquidity. And liquidity just simply means how quickly and easily can you access your money when you need it. So think about this. What if your car needs a repair? What if your furnace stops working? What if your hot water heater stops working? What if the furnace stops working? What if an unexpected expense occurs? The question really isn't just, do I have the money? The question is, can I get to it? That is liquidity. So the important thing to understand is liquidity is not good or bad. It's a design feature. And different financial tools are designed for different purposes, and they have different levels of access. So now let's look at some of those tools and examples and the access. So many of us have checking accounts, and a checking account is generally considered highly liquid because money can usually be accessed quickly for everyday needs. Its purpose is accessibility. So a checking account is easily accessible, not much interest involved in it, but it is easily accessible. Another area that we can talk about is a savings account. A savings account is also generally liquid. While it allows you to set aside money, and sometimes you get a little bit of interest, it's set aside for future needs, but it is pretty liquid. We have another tool that you can often get at a bank called a CD, or certificate of deposit. Now that's designed a little bit differently because your money is committed for a specified period of time. And because of that, accessing money early may involve penalties depending on the terms. So the trade-off is that you receive a stated interest rate for that period, but the accessibility or liquidity is impacted by the commitment of time that CD has. 401k. Now, I almost hate to say the word liquidity in with that one. A 401k is designed primarily for retirement savings. And because of that purpose, access before retirement may have restrictions, taxes, penalties, depending on your age and the circumstance of your plan, what you're using the money for. This design is for long-term retirement. So liquidity is different. I mean, each plan has different options, like some allow you loans, but a retirement plan, a 401k, is not as liquid as some of the other things we've mentioned. A pension is different from an account you access. A traditional pension is generally designed to provide income according to the rules of the pension plan. So it's going to go back to, and we often talk about this, even in the world of insurance, different companies write a little bit, maybe different riders. There's some general rules that everybody follows, but there's slight variations. Insurance is that way. A lot of that may have to do with, and I won't go in too far of a rabbit hole, but the insurance industry is regulated at the state level. So states can implement little slight different nuances. So a pension is different than like a general banking account or a savings account, because a traditional pension is generally designed to provide income according to the rules of the pension plan. So it goes back to your contract. The purpose is for retirement income. It's not immediate access, so it's not a liquid tool in the sense of you can get it tomorrow because you need a new tire. Another item that kind of comes up that people are invested in or have their money in is 529 college plans. A 529 plan is designed for education savings. The money is accessible, But the greatest tax advantages generally apply when the funds are used for qualified education expenses according to the plan. So in the case of this particular plan, the purpose matters. Even in the idea of a 401k, the purpose matters. Some are written in a way that you can take loans. Some are written in a way that a first-time homeowner. But you have to know the rules of the contract that you're trying to tap into for liquidity. Income annuity. An income annuity is designed primarily to create an income stream. Because the purpose is income, access to the original funds may be limited depending on the contract. Again, the design matches the goal. And what that means is you've put a certain chunk of money away to guarantee an income for the rest of your life. So that base is what's supporting that monthly income stream. So liquidity is basically, you know what the monthly payment's going to be if you've triggered the income paying portion of it, but the rest of it is probably not as liquid as what someone might think. A fixed annuity may provide access to money, but many contracts have surrender periods, withdrawal limits, and other provisions that should be understood. So the contract matters. So again, it gets into different things. We know that CDs have certain rules if you take them out early. 401ks have certain rules and penalties if you take them out early. 529s are specific to education. Income annuities, they're controlled by what their contract says. Fixed annuities, a fixed annuity may provide that access to money, but like we said, contracts have surrender, withdrawal limits, and other provisions that should be understood. So I think understanding this, especially when we get into some of these tools, is really important. Understanding that the contract matters and making sure that you have enough of your portfolio liquid in case you do need it for certain situations. Like for a lot of us, we may have an amount of cash value that we keep in an amount of funds that we keep in our cash value of our whole life policies so that we can utilize that as an emergency fund. So again, understanding the contract, how you can utilize it, how liquid it is, those are tools that are important for all of us. Now on to something near and dear to my heart. Annuities are near and dear to my heart, and so is whole life. A properly designed whole life insurance policy may build cash value over time, and that cash value may provide access to money through policy loans according to policy terms. So I kind of mentioned that a few minutes ago. If you keep a certain amount in your cash value, that may be a tool that you can tap into for liquidity if you have an emergency happen. But I started thinking about it, and I thought about like how I structured things when I first left the W-2 world, and I think I went more into private lending than I probably would have if I had really sat down with a different type of plan. And I was talking to a client earlier today, and he was talking about the same thing, that during that same period of time that I was making changes in my life, he was making changes, and his changes were connected to, was he going to continue in the field he was, because there were some demands of what needed to happen during lockdown, and if he decided to walk away, he was more or less in 24, 48 hours pushed into a scenario of making a decision, and maybe with more time or more pre-planning, he might have done his decisions a little differently. So I thought that's why this idea of liquidity was important to me today, because liquidity can be really difficult if you have a lot of assets and everything is locked up and you can't get to it in the case of an emergency or in the case of need. So really, the question isn't which financial tool has the most liquidity, it's how much liquidity do I need for the purpose that I am trying to accomplish. So I think at all points in our life, we need to know what liquidity is in what tool and how much do we have accessible for those things that we're not always going to be sure about. Because money needed tomorrow has a different job than money needed 20 years from now. A financial tool should be evaluated based on what it is designed to do. So the next time you hear someone ask, is it liquid? Ask one more question. Is it liquid for what purpose? And I think that is important to define, to understand, so that when you're making decisions, you have the right tools available. Insurance companies have to be forward thinking. We might be writing a policy for somebody who is 5 years old. That liquidity is not going to need to be there for quite a while. So the way that they're going to look at where they want those assets to be for liquidity purposes is going to be different. They can invest in a lot longer term because they don't have to have the liquidity as quickly. So what I just wanted to say is, This is just my opportunity to share some perspectives, and I'm going to get into deeper, more insurance terms and things from my career. But I just wanted to kind of start at the basics. One, it's an opportunity for me to get back into doing these daily lives again. But it's a chance for me to revisit and then to explain, and then for us all to kind of think about it. So I want you to remember, it's important to define things, to understand them, and then make decisions. And then until next time, I want you to stay curious, keep learning, and take ownership of your financial education. I look forward to these talks with you each day, and I appreciate all of your time. And until tomorrow, keep curious and keep learning.